back on Morning Movers with focus on retail. Target set to report earnings Wednesday morning. The company's had a rough few years. Stock down 60% from its all-time high in 2021. The retailer is expected to report adjusted EPS of $2.06. Revenue is expected to come in just under $25 billion in the second quarter. Target has lagged peers, rivals like Walmart and Costco significantly and has fallen 22% since the beginning of the year. Time now for Options Corner. Joining us to take a deeper look at this chart of Target is Rick Ducat, lead market technician. All right, Rick, so it's been a really difficult year for Target, difficult couple of years, honestly. What do you notice about the chart?
Yeah, you said it, Diane. A stock that just can't seem to stay out of the headlines, and usually they're not very good. But we see here kind of what you're describing, illustrating Target significantly underperforming the broader sector and consumer discretionary. You might think, well, consumer discretionary is a big sector. Maybe, retail itself is not doing super well. But as you said, year-to-date chart percent change, Walmart, Costco, Amazon all handily outperforming. So kind of like cheaper, bulk, and e-commerce all beating Target basically across the board here. But, another thing that's not really super great is look at discount retail versus Target. Target's kind of the more expensive, perhaps viewed as maybe a nicer option here. Dollar General, Dollar Tree, Five Below, all doing great. Ross store is a little bit of an underperformer there, but, kind of still outperforming Target here. So some food for thought there as we head into earnings. So we can see as well that when we look at our yearly chart here, we have a not great situation. You could say that perhaps we do have this upward channel type shape here between our two white dashed lines, but really not a significant amount of upside progress here. We are off about 20% off the lows to be sure, but still quite a bit of a road to travel before we get back up anywhere good for the bulls here. We can see volume nodes here at 105, here at 96, and up here at 115. So those would be some rather obvious points to watch out for these heavy trading areas here. We can also see our red line, 109, matches up with these high points we saw for price. That would be our ceiling. A recent floor around 98.44. So if we were to consider our moving averages as well, price is above them. They're moving sideways, slower momentum as we head into this earnings event here. We can see if we were to look at our expected move for August 22nd, this Friday, which will capture earnings, plus minus about 8.5%. Our yellow line here was our mark price when I did it. So not quite very much time here, but rather a larger move here. 8.5% could be kind of beyond what we've seen for the past couple months here. So should be an interesting one here for this beleaguered name.
Okay, thank you, Rick. Now to take us through an example trade, we've got senior options contributor Tom White and the other half of Fast Market. So, Tom, what's the approach for an example trade, especially given the challenging landscape it's been for Target?
Well, I think, traders look at things in a bullish fashion or a bearish fashion. Those are two directionally biased moves. Well, I've got a third for you, and that's neutral. So the way that I looked at this, stock's underperformed. It has rebounded, as Rick mentioned, about 20% from those April lows. The option market priced in about a plus or minus $8.50 move, just over 8%, as Rick mentioned. So implied volatility levels in the near-term options really elevated. So I looked at a strategy. If you think this stock's going to kind of consolidate, we're seeing that in Home Depot this morning, where we don't get any clear bias towards the upside or downside, and you can take advantage of that higher implied volatility. I looked at a strategy that takes advantage of it, and it's a neutral strategy, right? And I looked at a short iron condor, so we sometimes call this a short iron butterfly because it's the same common strike that I'm selling in this. August 22nd weeklies, so just an earnings play, 3 days to expiration on this. We're going to sell the 105 strike call and 105 strike put. So short a straddle there on the 105 strike. That's currently where the stock's going to open up here, about $105. And then against that, because we want to stay risk-defying going into earnings, we're going to buy the 95 strike put and we're going to buy the 115 strike call. So you're buying a strangle to help offset some of the costs and risk on this trade. So selling the 105 call and put, buying the 95 put, buying the 115 strike call. Short iron butterfly, you're going to collect roughly about a $7 credit. That's what you can make on this trade if it settles at around 105. Your break evens to the downside, 98 on the downside, and then 112 on the upside. So you have that nice big range for the stock to trade within. And the idea on this type of trade, Diane, is the fact that you don't expect it to go to $7 if the stock settles around 105. That's, the probabilities are very low. So what you want to see happen is post earnings, the stock consolidates. Implied volatility is going to get crushed, as we typically see post earnings, and that's going to lower the price of this $7 credit, where you can buy it back at a cheaper level. That's the whole idea of a neutral type strategy. You don't want those 2 or 3 standard deviation moves to the upside or to the downside. You just think it's going to consolidate, and you're taking advantage of that higher implied volatility. But this is another direction. It's just a neutral direction.
Yeah, that makes sense. That makes sense. So the example trade there, an iron condor, that's the approach for a target on an example trade basis. Thank you, Tom.